Hey guys, welcome back to my YouTube channel. It's been a while since I posted, and today I essentially wanted to bring you up to speed with where I'm at. If you remember, or rather, if you have watched my previous videos, you'll know that essentially on this channel I document my journey, my Forex journey, my findings on in as far as testing what's there online, or rather testing everything that's online, the strategies, the different approaches to trading, the different ways to looking at charts. And today I essentially wanted to give a summary on my findings in as far as hedging is concerned, and essentially when I noticed it's working, when I noticed it doesn't work, and essentially finding a balance. Because I noticed online, especially when you go through the forums, you'd find a lot of people either supporting hedging or bashing hedging, or supporting different strategies that are there online, and others fighting against them or trying to say that this is the only approach that works, any other approach doesn't work and it's dumb. And my channel isn't isn't aimed at jumping on any of that, but essentially appreciating the thoughts and ideas behind every strategy and trying to come up with an amalgamated approach, or rather combined approach, to view the market and view and essentially how to perceive different aspects of the market, and essentially crack the code using all the different ideas that everyone is discussing online and combining them into a filtered and well-defined approach to trading. You would find an approach, let's say, that works in support and resistance. Others use trend lines. And if you combine all these strategies, or in as far as I believe, you're essentially getting the general view of how thousands of traders have viewed the market, and deciphering it into a filtered approach to view the market. So in as far as my channel is concerned, I started with hedging, and I wanted to jump on and essentially in this video discuss my findings and explain where I noticed hedging works and where it doesn't, and potentially what you could do in as far as my findings are concerned. So in the past, I would say month or two, I've been developing different approaches, rather writing code, since I'm a programmer. In my day job, I essentially am a programmer. So I essentially took my knowledge from programming to essentially try to automate the process in all of these things. So for hedging specifically, I wanted to find the thing that makes it work, or rather the aspect of hedging that makes hedging work in different situations. What makes hedging work for certain people and why it doesn't work for others, and what's the missing aspect in all these situations. Before I continue, I wanted to first apologize. My boys are playing outside, so if you can hear any of that noise, I'm really sorry, but the kids, they're playing. So I just wanted to apologize for that. But in the meantime, I'll just jump in and try to explore, or rather explain, where I noticed hedging works. And for those who use hedging, you might and haven't really explored it in an in-depth approach, you might find it weird to realize that it isn't that different from how people use stop losses. But yeah, it isn't that different. But let's just jump in. For starters, I'd like to discuss when hedging works. So there are several situations where I found that hedging works, and this is essentially it. So hedging works, for starters, I realized that it works when the market is very, very volatile. Like, it works in the best ways possible. So I wrote a program that essentially balances trades and makes sure that you are hedged constantly. So when you, for instance, you sell at this point, and you had set a stop loss at this point, it essentially takes your stop loss. For those who have actually gone to my website or blog and checked it out, I wrote about it some time back. So it takes your stop loss, changes it to a buy order, and then your sell is essentially hedged. If the sell wins, everything is closed out and you end up with a winning trade. assuming you sold at this point and you had placed your stop loss here. So when the stop loss is triggered, the program essentially continues to trim this trade, the sell, as the buy heads higher. So for instance, if you had set a take profit on this trade for, let's say, double or rather twice the risk, so when this buy trade hits that TP, it essentially uses part of its profit to close out the losses from this trade and executes a new order at a certain distance from here, which you can define, and then it continues on in the normal way that we hedge. If you haven't watched or don't know what this means, you can watch a previous video. I'll link down some in the description that explain how this works. But essentially, I used that program to execute an arbitrary order in the market. So for instance, it would arbitrarily buy here or sell. So if the trade is successful, well and good, it finds another opportunity until the point it reaches where it essentially it is hedged. And at that point, it will continue following the market as it heads down, as it closes out this position. So I was essentially using that approach to kind of figure out when hedging works and when it doesn't. And something I realized is related to volatility. So I could elaborate this idea if I placed an order here, assuming this was a buy and you are hedging it at this point. The buy would of course be hedged by the sell, and you'll continue trading the sell until such a point, maybe it's at this point. So if you don't trade any additional trade within this range of sorts, I've just moved my order. Assuming this was a range, if the market just sticks within this level or this range, you essentially continue picking up the commissions and swaps and other fees related to hedging. I don't have a ready example on the market, but I could explain it by essentially drawing. So if I had a trade and I'm currently, okay, this is so weird. Seems I can't draw for some weird reason. These are tools that I use on a daily basis. But essentially, check this out. So assuming you have a sell here, and the market has been trending up, you've been trimming this sell trade, and now you have a buy here. This is a sell. So you essentially have two trades, and the market has been trending up nicely. You've picked up some profit in and around these levels, and you've balanced out. But then the market stops being this volatile, or rather moving in a specific direction with a lot of momentum and doing all that, and then it goes back within this range of your orders, in between the buy and the sell, and it continues within this range, because I've seen this happen in as far as my expert advisor is concerned. I've seen this happen where the market would stay within a specific zone for months on end. So remember, you have a buy and you have a sell, and for each month or day or hour, you're essentially picking up fees, especially swap fees. And at some point, your equity gets low enough to blow your account. And this can happen. This is a reality. This is a reality of the strategy, and it's something you need to plan for. Of course, there are situations or other approaches you could use to address this, which I'll be covering at the end, but this is something you need to be aware of. Something else, or rather, the second point I wrote here is essentially related to the lack of volatility. So if the market doesn't move, so volatility essentially is related to how fast the market is moving at a particular time. So if the market moves so fast within a specific duration of time, maybe in one day it moved 500 pips, you'll be making a lot of money in that duration as long as your trades are gaining profit. But if the market only moves 10 pips per day and your orders are not getting closed out and you're not essentially trimming your hedge, you end up in a situation whereby you're just picking up on the fees and you end up blowing your account. The other thing is if the market ranges in and around, or rather in between your hedge. And both of these factors I've seen, or rather I've noticed, tend to contribute to at least 50% of the losses that you encounter, just the two of them. So like 50% of the losses you'll experience, it's essentially related to either the market not being as volatile or the market just ranging within your orders. So at the end, I'll essentially cover a way to address this, but that's a factor you really need to keep in mind, and you need to find approaches to deal with them. Lastly, for when hedging does work, you constantly have a trade reducing the hedge. So this is an approach you could use to actually deal with the first two issues, or rather points where hedging might have an issue. But essentially, hedging tends to work very well if you have an order always being hedged. So for instance, you might have a buy here and a sell here, and when the market is going back within, you add another order, and maybe it's a great order, it's a sell order, and you don't end up getting hedged on the buy side. The sell side of things should continue picking up profits, and if you always have an order picking up profits from the market, you can continuously trim down your opposing orders and constantly make money. But if you don't have orders within this zone, if you have no orders and the market just ranges for months, you end up losing a lot, because all these orders that you're adding within here, or all these trades, are essentially helping keep your commissions and swap fees low, while while essentially closing out your losing trades. Because the aim of hedging is to bring your orders, or rather trades, closer to where the market currently is. So if the market is playing within this zone, or rather is within this area, you make more money if you have trades closer to this zone, because whichever direction the market moves after this, you'll essentially be making money. But if you don't have orders within that zone, or you've used up your entire capacity, or don't have any remaining margin, you're essentially losing out. That's why you need to be smart with it, and you need to always make the right decision, to essentially not always make the right decisions, but you need to always think about what you're doing before you do it, and think about how a specific trade could affect your capacity and your margin at any given point in time. So if you have a capacity of one lot, don't jump into one lot trades all willy-nilly, because you're not sure what will happen next. So you need to use as little of your capacity as possible. That's the maximum volume you need to trade on any given direction, and you need to keep that in mind. If you keep that in mind and essentially manage your risk, that's when you make money, because you are left with a lot more capacity to trade once the market moves away from your orders, or is in a situation whereby you are losing on both the buy and the sell situations. Yeah, so that's essentially a callback, or rather a reference to when hedging works. But there are situations where hedging doesn't work, and I've covered a few of them. So when the market is ranging within your hedge, when the market doesn't have a lot of volatility, and something that I should mention, when you keep getting hedged. So it is weird, like in your mind, when you think about hedging, as I've just mentioned a few minutes ago, it works best when you constantly have a trade working in your favor. But when you constantly have a trade that's getting hedged, you're essentially building up on the fees, and you don't end up making a lot of money in the process. Like if you have a large balance or a huge leverage, you could technically, this is on a technicality, you could technically work your way out of these losses. But if you don't have any of those two factors, and you keep getting hedged constantly, you essentially end up with a losing situation that will not work in your favor. Or that's at least as far as I can see, based on the expert advice and as I'm testing it out. So assuming you have a trade, I should have used this one, it's cleaner. But assuming you have been hedged, you have a buy trade here and a sell trade at the bottom, and you are currently hedged, and you think of taking another order within. And this order, let's say you think of taking a sell. You take a sell, and then you place a buy stop to essentially hedge this sell, just in case things don't work out for you. And the market instead goes higher and triggers your buy, and then goes lower, triggering your sell. And then now you have another range within this zone. So if this range was, let's say, about 200 pips within here, you could do the same thing and add additional trades within this zone, and you end up not, and it ends up getting you in a hedged position again. So when you are constantly getting hedged, it essentially increases your likelihood of picking up on a trade that's losing a lot, like this one and this one. And then it's also losing you out on swap fees and commissions. So you're essentially building up on fees as opposed to building up on your balance, which should be the goal of the strategy. You build up on your balance and use up your available margin and leverage to essentially build up your balance higher, so that you can withdraw at certain durations. At the end of the month, you withdraw bits, and then you constantly do that until you've made back your money. So this is a potential issue that you need to keep in mind, because if you don't essentially have a strategy that can work, or rather a strategy that has an edge in the market, it ends up eating back on your equity and eating up your equity, eating up your margin, and building a lot of fees that essentially end up killing your account, and you end up blowing your account. So what's the solution for this? Of course, for those who are already catching up on what's happening here, you will notice that it's the same as someone who's trading using stop losses, and you keep taking bad trades or trades that don't have any edge or are not likely to win, just for the mere reason that you think because you're hedging, you won't experience the loss. And this is something that most people who hedge don't essentially think about, because hedging as a strategy, and this is something I discovered too, hedging as a strategy doesn't delete your losses, doesn't prevent your losses. Actually, oddly enough, it tends to hide your losses. So at the end of the day, if you're constantly trimming, and never really analyze the trades that you're taking, the losses that you're making, and this is something I've noticed certain groups, or rather online people online trying to encourage, that when you jump into hedging, you won't have any losses, and that's essentially a lie. All that's happening is that you are not as aware of your losses as you could have been if you're using stop losses. When you're trading using stop losses, the market hits your stop loss and you immediately notice that you're out of the market. But when you're using hedging, the market will trigger your hedge, and you'll see one of your trades essentially making money. This one will maybe have a loss of $600, and then this one could have a profit of $300. So at the end of the day, you have some profit, and if you used part of it to close this trade, when you're closing it out, if you don't, this is actually for the people who do not monitor their losses. If you don't monitor the losses that you keep closing out, you'll never really learn. You'll never really improve on your approach to trading. You'll never really improve, or rather build up on your edge. You'll never really try to improve what's happening in the market and determine how you could improve as a trader, since you're just focused on trimming as opposed to being focused on building a strategy that works. So at the end of the day, you will notice that for people trying to look at hedging as a potential escape to trading, and as an escape for not building your strategy or building an edge in the market, that's essentially the wrong way to look at things. Hedging should be an opportunity to allow you to observe the market. Of course, I'd recommend using a demo account for this, but an approach to observe the market, and you build up on your approach or strategy or way of looking at the market. In this manner, you essentially end up in a situation whereby you've built a strategy that works, and at that point, whether you use hedging or stop losses won't make a difference. At the end of the day, both of these are just tools to manage your risk. So for someone if I can go back to my previous point whereby you keep getting hedged, that's very similar to someone who keeps hitting the stop losses. The only difference between you two is that the one hitting the stop losses will see the loss immediately in the account and maybe might take actions to mitigate that in the future. But for you who are hedging, you won't essentially experience it immediately, and you'll keep trying to manage your trade, which is good and all, but if you never really think about the trades you're taking or try to build an edge in the market and improve your strategy, you never really get out of these trades. And if you constantly are getting hedged constantly without taking any free trades or trades that are not essentially hedged, you end up losing your account and you will blow your account, several of them. So I'd very much try to recommend improve on your strategy, build your edge in the market, because at the end of the day, once you do that, that's how you improve. So essentially, if you do not have a strategy, you can hedge, but do it on a demo account. Essentially, now I can actually jump into what you can do to deal with all these issues. And I had a few notes and stuff that you could do. So you could, and this might sound dumb or it might be some bad news for those of you out there who want to trade without a strategy, but the first thing you can do, and it will really actually be freeing, is to build a strategy that works. If you have a strategy that works, remember, I just showcased that if you do not have a strategy that works, you'll essentially keep losing regardless of which risk management approach you'll use. Hedging allows you to stay in the market for longer. Hedging allows you to be in the market, to feel the flow of the market, and it has its advantages. But if you don't have an edge, you will lose your account. You will blow your account on fees as opposed to blowing them on stop losses. It's just a different kind of cost that you're experiencing in the market. So what I would recommend is to either develop a strategy that works, or you use hedging as a way to stay in the market and observe everything from a participant point of view. In this case, if you don't have a strategy, please use a demo account. At the end of the day, if you use a demo account, you'll be entering the market, observing the market, seeing that maybe after, let's say, an engulfing candle, you notice the market moved a lot. You go to FX Replay or your favorite backtesting tool and you test it out because it's something you noticed. Being in the market, or rather being in the flow of the market, benefited me a lot, in as far as, since I'm not trying to find winning trades, of course, when I was using a demo account. So since I was not targeting winning trades, I was essentially just trying to be in the market and being present. And this allowed me, for instance, to notice that when XYZ happens, this tends to follow. Because when you're not in the market, you're just looking at it with hindsight bias. Essentially, assuming you're here, you're at this point, and for those of you, so let me just show this to you. So let's assume that you are at this point in the market. You saw a huge red candle, and if you were at this point of the market, looking at the market at this exact point live, looking at the market live, or rather it's a backtest, you might make a bet that maybe based on what I can see, the market might be heading down. And then you lose that bet, whether it's a demo account or a backtesting session, you lose that bet, quote unquote bet, that you've made in this situation. And once you lose, since you're in the market and are experiencing the market, you notice, oh, okay, so I was wrong. Why? And then you start digging deeper and trying to find the patterns that work for you because you're present in the market. That's option one. You could use hedging to jump into the market. And oddly enough, this will show you some very weird situations. Like in the past, when I was using a demo account trying to hedge, I realized that I could come into the market. I see that the market is bullish. I'm just giving an example here. I see that the market is bullish, but then I say, okay, maybe the market might be heading downwards. This candle was larger, this one is smaller. Like I'm just coming up with reasons right now. I'm just looking at the markets and coming up with reasons. But essentially, I decide to sell, and then I get lucky. And I start to ask myself, what happened? And at this point, actually, hedging teaches you to understand that anything can happen in the market. And I mean, anything can happen in the market. Okay, in as far as the market going up or down, like you won't see a shark jumping out of your charts, but I think you get the point. Anything can happen in the market in as far as the market going higher or lower, regardless of what your edge might be. For instance, your edge might be break and retests. And at this point, you might be waiting for a break and retest of, let's say, this level. But the market never really gives you a perfect entry at this point. As you can see, there's no perfect entry unless you're looking at this point as the perfect entry, in which case the market really doesn't head higher. So at the back of your head, once you are a participant in the market and are using hedging, since you know whichever direction the market will go, you'll essentially be making money. You essentially do not place any level of expectations in the market. You allow your edge to play out, but at the back of your head, you're saying to yourself, if my edge doesn't play out, my hedge will take care of me. My hedge will essentially make sure that I can manage my risk as opposed to taking that loss. That's essentially the gamble you're making at any given point in time when you're hedging. And at the end of the day, that's a good strategy to use because I used it in the past and it definitely worked for me. It allowed me to start perceiving aspects in the market. And sorry about these markings. I was actually thinking about something when I noticed the market behaving like this. Actually, you could experiment it for yourselves. This is something I noticed, that when the market makes essentially ranges for a bit, this is the 4-hour time frame. When it ranges for a bit and then it closes out of those areas, I was trying to find something in the market that essentially can act as a precursor to a big move. And this is just an experiment I was doing, but you could exploit. And this is actually what I'm talking about. Experiment. And hedging allows you to experiment with all these aspects. And that's what I essentially encourage you all to do. Take hedging as a way that allows you to experiment and find new details in the market. And lastly, something that I am more focused on in as far as the experimentation side of things, I am trying to essentially, since I'm trying to find different strategies that work, and essentially separating the man from the idea, as some of you might refer to it, I'm essentially finding different strategies online, whether they're being bashed or they're being celebrated. I'll test them out all. I'll test them all out. If you'd actually want to see me testing them out, please comment below and I'll be doing that. But I tend to do that by myself and then review the results. So in this case, what I would recommend, which is something I also do and I'm doing right now, you find a strategy, test it out using stop losses, and then test it out using hedging. Essentially, you'd find certain strategies have a very high strike rate, but then or have a very low strike rate but are very profitable, or have a high strike rate but not profitable. What if hedging could switch them out, or rather could change them to a profitable position? And this is something I'd recommend you do. So what I have been doing, I'm building tools that make it easier for me to hedge, or rather to do the calculations, so that once I'm done with the stop loss side of testing, I jump onto the testing side of things, which essentially uses hedging. So for strategies that I can quickly code up, like recently I was testing one whereby you have the 200 EMA and the MACD. I don't know if I no, my MACD sucks. But it looks something like this. So if the MACD crosses and the trend is in line with the 200 EMA, you buy or sell, and then you hedge. So I was recently testing that out. So strategies that I can quickly code up, like those ones, I code them up, and since I already have an expert advisor that can hedge, I just attach it to the same chart and just watch it go. Essentially, using that approach allows me to deal with one of the most significant problems that is or could be associated with hedging, that is not having an edge in the market. If you don't have an edge in the market, you're more than likely to get hedged every so often or ever so often. Let me show you an example of what I mean. I know I've already discussed this severally, but I think a clearer example could be given in as far as hedging is concerned. So assuming, and this is just assuming, that you want to trade, what can I see here? Let's say break and retest. And you say that this is your level. I know for those who trade break and retest, you might correct me on this. I'm not sure. I don't really trade it, but I'm not sure whether this is a valid entry. But you could test this strategy out and maybe say the market is reacting at this point and you place a buy. If your stop loss was at this point and you're testing the stop loss based approach and you have limited your mind to only perceive stop losses, you will only perceive the solution at this point as increasing the stop loss. Like, I'm almost 100% sure that, or rather let's say 80% sure that that's the conclusion you'll come to. But for anyone using hedging, you might perceive that, okay, I could place my stop loss here, but instead place a hedge sell. And as the market is heading higher, and this is just something I'm coming up with right now. So for those of you who want to test it out, you can. As the market is heading higher, and since I'm trading break and retests, I will continue adding orders, trying to find. I'm really sorry if I'm butchering the strategy for anyone who trades break and retests, but I could find potential entry points, or maybe for those who trade order blocks, since actually I've explored a lot of strategies online. That's why you can see I can maybe detect some of the aspects that they look at. So for instance, here you could find an order block and then I add another trade. So every time I add a trade, you could be moving your stop loss for the loss, not really your stop loss. You could be moving your sell trade and increasing or reducing it based on the profits from these two trades. So like you could close out a bit here and you move your maybe profits, or rather take profit of this trade to the break-even point, and then as the market heads higher, you continue moving the take profit from this trade, and you continue to try and find different entry points. So I'm just guessing here. I'm guessing, I'm not really executing any trades. I'm just showing you an example of what you could potentially do. So by this point, since remember you haven't been hedged for this trade, you still have a trade at the bottom, but it's not hedged, and this one, and this one. So you have one trade that's hedged. Let's say your capacity is at 2 lots, so you have 1 lot and 1 lot here. This one you have 0.5, and this one you have 0.5, and the equivalent sell trades. Yeah, since this sell has not been triggered, you could opt for moving it at this point and instead having a 1 lot sell trade at this point. And once the market gets to this point, you could use the profits from either trade to close out this trade, the 1 lot at the bottom. As this trade is losing, you could close out this one. Like, you could determine you could have very many different approaches of managing your risk based on just having a strategy that works. And I know my drawings here should not be taken as an approach that works, or rather should not be taken as a testament that this strategy works or not. This is just an example, and this is what most YouTubers do. And I'm sorry to say, I'm really sorry to say that for most YouTubers, or rather for most that I have watched, what they tend to do is to only find the situations that work for them, or rather they find examples that work, and that's what they'll show you. That's inclusive of traders who hedge. Something I noticed, and this shouldn't be taken from me or an opinion by myself in as far as hedging is concerned, but it's something I noticed that most traders, even the ones that are demonstrating hedging strategies, they essentially cherry pick their entries. They cherry pick specific situations whereby they'll exit hedged trades very quickly. And I'd recommend you to, this is why I always recommend test out the strategies yourself. Test them out in different situations. Jump into a trade randomly and then see why the random approach does not work. Or rather, based on my testing, I can say it doesn't work. The approach that actually works is having an edge that tells you, if you buy at this point, let's say, and place your hedge here, this trade is more likely to win and you're less likely to get hedged, which is actually very similar, as I hinted at the beginning of the trade of the video, to people who actually use stop losses. At the end of the day, these are just two different approaches to managing your risk. And if you'd like to go with the full-on discretionary approach, which I've seen tends to be recommended for hedging, whereby based on whether it's your emotions or how you feel about the market, you could choose to sell at this point and you'll be hedged at the top. So if this trade wins, you're good to go. But assuming you sold at this point after seeing this huge candle, I don't know if you can see it, after seeing this huge candle, and you decided to sell, you'll essentially be hedged. And if you manage your hedge very nicely, you could exit out of all these positions. But once you end up with a buy trade here and a sell trade here, believe me, the only thing that could increase your likelihood of exiting both of these positions profitably in the long run is having a strategy that works or finding an edge. So this is essentially a call to all of you. If you'd like to improve in your trading, try to focus on building your edge in the market. Use hedging as a tool, not as the strategy. I know this hedging is recommended as a strategy, but I am recommending it as a tool for risk management. Use it as, since it hides your losses and it's essentially better for you psychologically, use it as a tool to discover new strategies, to test out new strategies without feeling the potential pains and angst related to stop losses. Use it as a tool to discover who you are as a trader and get in the flow of the market. And that's essentially my message in as far as my channel is concerned. Don't bash any particular strategy. Even for those using the moon or different natural phenomena to inform them of when to trade and when not to. Essentially, try to build your approach to trading and not focus on all the politics that are related to fighting a different strategy, calling another strategy dumb. I definitely recommend focusing on your own journey and being consistent with it. Be consistent about whatever you're trying to build. At the end of the day, regardless of which tools, because all these strategies and everything online, I'm just considering them as tools. Regardless of which tool you're using, as long as it's giving you the results that you want at the end of the day, I definitely recommend using it. So that's essentially my message for today, and I'll be making more videos in as far as backtests are concerned. And if you'd actually want to see backtests, not specifically related to hedging or stop losses, or basically generally exploring a strategy and seeing why it works, exploring the essence of all these strategies, definitely comment down below, and I'll definitely be jumping into that. And if you'd actually also like to test out my expert advisor, I have one on CTrader and another is on MT5. I don't have anything yet on MT4, but I'll soon be developing that too. It's just that I tend to use CTrader and MT5 a lot, so I built out two approaches and I've been improving on them. Also, check out my website. That's where you could find details on that. But in the long run, please, 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 backtest, backtest, backtest. Test out every different strategy out there. Explore them. Maybe you might find some little tidbits that help improve your own approach to trading or how you perceive the markets. But in the long run, try and be consistent. Find something that works for you and be consistent. Hit it up on a daily basis and continue testing it out. For those who are new here, thank you so much for listening, and for everyone who's been with me so far on this journey, thank you so much for the support, and tune in for the next video. Essentially, don't forget to like, subscribe, and share this video, and actually follow me on Twitter at smallstepfx, all lowercase, single word. Follow me on Twitter. I definitely post a lot on a daily basis, and also check out my blog. It's on my website, but I'll soon be creating a Substack one so that you can continue getting notifications on everything that I'm discovering. I'm planning to start on writing more, since I tend to prefer the written form in as far as communication is concerned. So I'll be writing more in as far as my findings are concerned, everything that I'm discovering, and I'll also start posting my actual results in as far as the videos are concerned, what I'm discovering, and my findings. And if you have any recommendations on that, please comment them below or shoot me an email or a message, whichever platform you decide. I tend to be very responsive on any given platform. And thank you so much for watching this video. Cheers, and hope you have a great, successful, and profitable trading week and career ahead. Cheers.